If you put the hard work in, you will be successful. If you don't put the hard work in, you won't be successful. But if you do put the hard work in, you still might not be. A friend of mine raised a pre-seed round out there from angel investors, raised nearly £1 million, raised it in 8 days. It was literally, I've got an idea, got the distribution, I know what I'm building, it's £1 million round, I think he did it on a safe. Are you in or not? The majority of people that I know that don't go to work have ran small SMEs and successfully exited them for 7 or 8 figures, but own 80-90% of those businesses, whereas VC is the exact kind of opposite game. If your only metric is the amount of funds that have been raised through that program, I don't think you're giving founders the best advice.
Hi everyone, welcome to 23 Mile with me, Catenae Advisory. Today we're joined by Kiran Mehta, former investment manager at Mercia Ventures, now founder of Catenae Advisory. Kiran spent years deploying over £20 million into early-stage tech companies. In that period, he invested in 11 businesses, sat on every board, and reviewed thousands of pitch decks. His path into VC wasn't straight and normal. He broke in without an Oxbridge degree or the investment banking background, which is common for aspiring venture capitalists. But after being one of the lucky few to break in, he walked out of the door. What's interesting about the conversation we're about to have is that Kiran is pro-VC, naturally. He believes in it, he's lived it. But where he stands out is how vocal he is about the fact that majority of founders have no business raising venture capital. And so on the show today, we're discussing why venture capital works in scaling businesses, why it's not for everyone, and how founders can make that decision on whether it is for them or not. We'll also touch on the non-linear career path is pursued, and which will be more common for many people going forward. Kiran, welcome to the show.
Thank you. Thanks for having us, and appreciate the intro.
Cool. Let's start at the beginning. I remember a few years ago, there was this phrase that was quite common, breaking into VC. Was it this period you got into, or a little bit before that hype cycle?
It was probably just around that. So I joined VC in 2021, and obviously kind of 20, 21, 22 was the kind of peak times, at least in this kind of last economic cycle for VC cash. So I was probably just ahead of that kind of wave of everyone trying to pile in. I mean, obviously, in its simplest terms, there's more VC roles going when there's more capital to deploy, and there's more capital to deploy when interest rates are lower. So probably timed it right in terms of when I got into the industry.
Sometimes I founded a tech startup as well in that exact hype cycle, February 2021. I can't forget. But let's get back a little bit. You got in after a business management degree and through banking. What was it like? Maybe let's just walk into, talk about the banking career. How did you get into banking?
Yeah, so I left uni with a business and management degree. So jack of all trades, master of none comes to mind. But you wouldn't necessarily be an expert. Same with marketing, same with HR, same with a lot of different things. And banking was one of the roles that just really resonated because ultimately, yes, you've got a little bit of finance and you can compete with other graduates, but actually when you're assessing the businesses that you're going to, in that case, lend money to, actually knowing a little bit about everything really helps. Applied for a few grad schemes within the sector, got offered a couple, took the one that was nearest to home, right? Great career decision. But that was it. I guess we'll probably kind of touch on it as we go through, but I guess the majority of things I've done in my career has just been about taking that next step. When I was in banking and I was on the graduate program, you kind of look at people that kind of people would give a presentation of, this is how you plot your career out. And it sounds great, right? It looks great on a piece of paper. Actually, that's not really been my experience. My view has always been, as long as the next move is better than the one that you're in now, just do that and then just see what happens. And that's kind of how it all started, really.
Banking, graduate and program, that's my story as well. I started my career with what I thought was going to be a few years in banking, and ended up as 13 years. So, I can feel what you're talking about. But you touched on something there, which was, a generalist role within banking.
Yeah, ultimately assessing a business is broadly similar. You're framework and decision-making process for an equity investment is obviously very different than it is to a loan. But fundamentally assessing, is this a good management team? Does the financials stack up? In banking more than VC, you probably actually need to know your way around a P&L and a balance sheet and everything else. So all those kind of core skills of assessing how do you think about different businesses was very similar. Obviously, the big difference being once you've done all that analysis in banking, you kind of take the view of we're going to pick the lowest risk one because actually the return is similar. Whereas obviously in the equity world, you're actually trying to see what it's more of a kind of direct correlation between risk and return because you can obviously adjust the pricing, which is a bit more difficult in banking.
Awesome. You've said it somewhere that you got into banking 10 years too late. Is this, a result of your direct experience of what was going on in the industry?
Yeah, just what was going on in the industry, really. So obviously, when I started my career, it was like mid 2010s. So kind of financial crisis had been and gone, but the effects of that were still around. So the bank that I joined when I started my career, they were still government owned or partially government owned. When I got involved, so that kind of long tail of stuff that happened after 2008 was still washing through. It was kind of probably a bit of an intersection where like the commercial and corporate banking was tailing off a little bit, and retail banks were more looking to do more consumer stuff. So the risk appetite was pretty low. So that made it quite difficult to get involved in any interesting businesses. I mean, obviously, risk appetite is always going to be less than equity, but even with accepting that, it was at a time where it was like very, very difficult to get involved with many interesting businesses. So that was kind of one challenge. And then secondly, just to kind of team bloat, I can't remember the exact stats, but there was a mass headcount reduction over a significant number of years, both kind of before I started whilst I was there and then the immediate period afterwards. And it's just never a nice environment to be in, right? Especially if you're on a kind of graduate scheme program where you're insulated from that, but you're still in teams where teams are being affected by restructures. So it was a great learning curve. It was a good place to land. But yeah, definitely wasn't what I wanted to do long term. Just wasn't interesting enough. I think probably one of the bits I've learned through my career, I always, like at the start of it, I think probably instilled by parents a little bit, the view was go and work for a big business because there'll be plenty of opportunities at a big business. And actually my experience in my career has been the size of the business doesn't matter. It's about the growth, or in that case, the rate in which it contracted, where the opportunities really come out.
Yeah, I'm interested. We'll come back to this restructuring, point later on. But what was the trigger for leaving banking eventually?
So I was on like a 2-year program, did kind of 15 months of that, wanted to get off that as soon as possible, primarily because you got a sense of different areas of the business, but you didn't really have real responsibility. And that was what I wanted, to have responsibility and be accountable for stuff. So I wanted to get a proper job, I guess, in air quotes, as quick as possible, to round a few opportunities in the bank. At that point, I knew I wanted to get into private equity or VC. Couple of opportunities internally I applied for in like the leverage finance teams, which are kind of providing the debt on private equity transactions. So that would have been a kind of step in the right direction there. But then equally at the time, Lloyds were setting up a real estate equity fund, which was kind of incubated within the bank. So we used like their IT and their offices and stuff like that, but it was separate entity. At the time, it was a separate logo. Looking back, I think that's merged a little bit now. But it was like a business within a business. It was almost a startup. When I joined, there was probably 15 people in the fund. And it was real like beg, borrowing and stealing and learning stuff off the side of the desk. I ended up for a while managing our outsourced marketing firm, not a marketer, not got any background in it, but just had to figure it out on the fly. Helped with the team when they was raising their second fund. So I ended up, like, me and one of the other associates spent a couple of weekends building a prospectus to go out and raise on the back of, again, zero experience in that. It was just pre-chat GPT, so lots of YouTube videos and Googling. But yeah, it was cool. It was like a little startup experience. So quite a natural kind of fall off point, kind of come out of the bank, but actually still stayed within that little kind of ecosystem because they were one of the LPs in the fund that I joined.
Very interesting that your career path kind of almost similar to mine. I started off with retail banking, did a bit of strategy, and I got into leverage finance, which I did for 8 years before I left the bank. But interesting. And then you did that for a while and ended up in Mercia. Let's talk about that. How did you eventually get that the proper VC job?
Yeah, so Warm Network. So one of the the real estate fund that I worked in, I was an associate, and the investment manager that I worked with, he had a leverage finance background, and he wanted to make that step into PE and VC as well. So I think I'd been there about a year. He left, he joined Mercia, stayed in
Oh,
touch with him, kind of probably met up like once a quarter. We was like friends anyway. Was just genuinely interested in what he was doing, so just ended up asking him loads about the role, how's it going, what's different, what's the same, all that other stuff. And it was really good fun. And then 2 years later, he said, "Oh, there's a role come up. Do you want to apply?" And in the meantime, I'd been applying for roles in PE and VC anyway. I think I'd applied for probably about a dozen roles at that point.
oof.
Got a few interviews, but never really got past that. And the feedback, especially more at the private equity end of the market, was, "Yes, you're a chartered accountant, Len, thanks, but no thanks." But yeah, ended up kind of interviewing. But because of just staying in touch with him over the course of 2 years, and like I said, probably met up like 6 or 8 times in that period, and just asking him about the role because I was genuinely interested. When it come to interview time, all the questions I kind of had an answer for anyway, just because I'd kind of learned about the industry through asking what he was doing. I presume he put a good word in somewhere behind the scenes as well. And then just kind of went from there really. And then I joined the start of 2021. My first day in the office was 2 days before the second big lockdown. I
Mm.
applied. I think I applied in the September. No, sorry, I applied that summer. I got offered the role October, November time. I was meant to start on the 2nd of January, and I don't think I met anyone until April. So
Ah,
it was
tough.
quite a weird time to move roles. I remember even leaving my previous role. I had to go in the office and just leave my laptop there. None of the team were in. So yeah, weird time for a career change, but worked out okay.
Tough times, but like I said, tough times don't last.
Yeah.
Okay, very interestingly, I mean, a bit of a personal story as well. I spent 13 years in banking, all the experience with leverage finance, all those analytical stuff, understanding of private equity. But I thought I knew what venture capital was, and when I founded a tech startup in 2021. But it took me 2 years to realize that I had no idea what exactly venture capital is. It's very opaque. Let's from the inside, tell us what exactly is venture capital? How is it different from banking? How is it different from private equity? And what are those things founders should know about what VCs do?
Yeah, it's interesting. So I get this question a lot, and the part of the challenge is VC is very, very varied. So in its simplest terms, and I presume a lot of listeners kind of know this, it's ultimately people invest in very very early stage into very early stage businesses and taking a slice of that business to do so. So there's probably no revenues, or there's very little revenues if there is. There's certainly no profitability. And it's ultimately people taking a punt on what you're trying to build. So relatively limited intrinsic value on day one, but potential for significant kind of upside. And then your question was interesting, is how does that differ from private equity? And that really depends on which fund you speak to. So, when people think of the tier one funds, they've always been in that venture space, and they've always had that mindset of there's so much risk here. There's very little for us to really get under the bonnet of, but we're taking a fundamental punt on team, market opportunity, and the ability for these guys to execute. The challenge comes sometimes with some of the funds where you've got ex-private equity guys running VC funds, and private equity is all outsourced due diligence, complex structuring, heavy fees. It's just a whole different process. And that actually, I find that part of the market is very difficult for founders to navigate. So yeah, I guess that was a long-winded answer, but it probably depends who you're speaking to.
I think great answer because I mean what the key thing you said there is it's very varied. And so there's early stage, there's late stage, there's tier one versus tier two, all sorts. And then there's also that dichotomy between how venture capital is practiced in the UK and Europe versus what it is in the US. So we can touch on that in depth later on. But maybe just, very briefly here, how do you see that different if we stick to early stage investing? How is it different in the UK versus the US?
Quite a lot of ways. And again, I kind of caveat it that there are definitely some good tier one funds, in particular, kind of some of the guys that are operating out of London that operate with more of a US centric model. But if we think about the averages of, and I presume it'll be the same the opposite way around, right? I'm sure there's US funds that are heavy on structuring and slow on process. But on average, US rounds get done really, really quickly. So a friend of mine raised a pre-seed round out there from angel investors probably a year ago now, raised nearly £1 million, raised it in 8 days. And not as in like 8 days from a term sheet, as in the first time he sent his pitch deck to the first amount, it was a rolling close, but to the first amount of cash that come into the bank, which was the most material part of the round, it was 8 days. It was literally, I've got an idea. The guy had a very, he had a good distribution already through his own kind of networks. Like, I've got an idea, I've got the distribution, I know what I'm building. It's £1 million round. I think he did it on a safe. Are you in or not? And people would make that kind of very binary decision. And he got some really high profile angel investors on the back of that. I'm yet to see a deal in the UK that gets done in less than 8 weeks. And I've seen some deals in the past couple of years that have taken 8 months, and that's not an exaggeration. So speed is definitely a big differentiator. And I think speed percolates into a lot of different things. Ultimately, founders are fundraising as a full-time job when they're fundraising. And when that takes you, okay, 8 months is extreme, but 3 to 6 months, which is probably the average at the moment in the UK, they're just so ground down, they're so tired. And then to get back into business building, there's always then a kind of gap in between. And I think US in general just has that more of a mindset of, you just need to get, what you don't know after them first 2 meetings, assessing a pre-seed or seed stage business, you're probably never going to know, right? So
Yeah.
it's just about kind of rolling in and just going for it, I think, which is one of the big differences. Obviously, US, you've got a lot less frequent fee culture, so it is just usually kind of straight up equity. Quick, bigger checks as well. Now, obviously, you've got a few bits that factor into that. So yes, the bigger checks, but if you think about how big you can grow a national business in the US, it's obviously significantly more than the UK, just purely based on population size and the amount of kind of companies and the essentially combined kind of GDP of all those companies. So you've got that aspect, and obviously talent is more expensive in the US. So twice the round might only buy you the same amount of talent, but the two big things really, speed and size of check, and I guess valuation kind of ties into that a little bit as well.
At the risk of oversimplifying, is it safe to say the US prioritizes people while, say, the rest of the world focuses more on the process?
Yeah, a little bit, and I think that goes back to kind of backgrounds of people that run US funds. So you could probably take US and UK out of this conversation, and you could replace it by funds run by financiers and funds run by financiers and funds run by ex-operators. And I say that as someone that's had a kind of finance background before getting into it. But yeah, I think the people that have built businesses understand that, you can't grind someone down for 6 months due diligence process and then say no at the end of it, or even, if you say yes, then expect them to hit the ground on day one. So yeah, I'd say it is a bit more people centric, primarily because more people have walked in the founder's shoes in that space.
But considering how hard it was for you to get into VC, and how hard you fought to get in, how all the interesting stuff you were seeing, isn't it quite shocking that you left after just 4 years?
Yeah, a few people say that to me, and yeah, it probably isn't the route that most people would have took. And look, I loved my time in VC, and I wouldn't be able to do what I do now if it wasn't for that experience. Like the people that I worked with, the boards that I sat on, the non-execs, some of the people I met, it still even to this day just kind of blows my mind the amount of kind of access and network I got. So it was really good fun. But ultimately, I think for everyone, you've got to sort of look at what you're doing day to day and ask yourself which bits of that you enjoy, and try and do more of what you enjoy and less of what you don't enjoy. And there was two big things for me, like, VC is a game of doing deals and making investments. And you've got obviously meeting founders, which I loved and everybody loved. You've got the actual nuts and bolts of doing a deal. So, legals, due diligence, all that other stuff, writing investment committee papers, which I hated, probably didn't at the start, but kind of grew to hate. So yeah, that was part of my thinking of how do I kind of get out of that and get back more to just doing that kind of stuff, which I'm sure we'll come on to in a minute. And it's funny, I look back at I had 4 interviews when I joined the fund that I work for, and the last interview was just very much that kind of sense check with one of the senior guys, and they asked that classic question of what one thing are you not good at? And I said, to be honest, I just don't like playing office politics, and I don't like working with people. And that was my feedback. And it was kind of weird. I've never seen anyone looked as Give me the look that the guy that was doing the interview did, as to say, has this guy really just said that on an interview that he doesn't like working with people? But that kind of was the truth in a sense of, I think I've always been like a bit of a bad employee in a sense of I'm not easy to kind of manage. I want to do my own thing. I index very high for freedom and autonomy. And I was getting to a point in my career where you go, you can't get that, right? You either have to play, you either have to kind of play ball as an employee and kind of fall in line with certain things, or you take the view that you've probably got to be your own boss because you don't like being told what to do. And I'd got to that point where I wanted to work directly with founders. I wanted kind of full freedom and autonomy over what I did and what I didn't do. And that kind of led me to kind of going off on my own and just setting up my own little advisory business.
Certainly, Flex, and we'll come back to that. We'd like to hear about how you're using your experiences there to help founders. We're just moving on to the a bit into the VC as an asset class and as a fuel. And you look at a couple of examples. So like Deliveroo with an IPO that they sold again last year. You look on the other side of the pond with Figma and their IPO and making their two founders billionaires under 30. When VC works, it really, really works. But how rare are these outcomes, these billion-dollar outcomes within? I mean, how rare are they from your experience investing?
Yeah, I mean, look, I left VC 2 years ago and I'd been in there 4 years. The tail of businesses exiting is still a kind of good way in the future. So yeah, I probably can't give you any kind of direct stats in terms of my own portfolio, because even the ones that are doing really well are 5 years plus away from an exit. I saw some stats a couple of years back, probably out of date now, but I think there've been 5 unicorns in the UK that were still VC backed to exit in software in the last 10 years. So the big outcomes are definitely less in the UK than they are in the US. To be fair, Europe's catching up. Obviously, Scandinavia's got quite a few big winners coming through at the moment. But yeah, look, it's a game of chasing outliers, right? And even the ones, so hard to get VC funding, right? I think it's like investors invest in less than 1% of the deals that they see. So it's hard to get in. And then the amount of deals that actually go on to, return the fund, as the classic example, is obviously a subsection of that as well. So yeah, I don't know the exact stats, but if you want a low risk way to build a wealth creation, you're probably not choosing VC. If you want a very, very small chance of being an absolute outlier, the billionaire under 30, then VC potentially is the model for you. Where I live in the north of England, the majority of people that I know that don't go to work have ran small SMEs and successfully exited them for 7 or 8 figures, but own 80-90% of those businesses. Whereas VC is, the exact kind of opposite game. Not saying one's right or wrong. It's just about picking the right thing for, 1, the business model, and 2, the founder's appetite.
I mean, unfortunately, a lot of people don't see what you described there. The wealthy guys who've built non-flashy businesses and made it succeed. I will come to that. I mean, it's actually one of the parts I'm looking forward to. But let's talk about this minute chance of massive outcomes. From your time as a VC, how do you look at a founding team or a pitch deck and say, this is likely to be a success? I want to be part of this. What's kind of like, do you have like a simple framework that you came up with over time?
So that's interesting. So is there a simple framework to assessing a good VC deal? Definitely not. Because if there was, everyone would be doing it. And I think it's a lifetime of learning, more so than any other role, because you're not only the data that you've got, and this is part of the challenge with VC, right? If you think of 10 years to an exit, the data you've got when you look back on something, you're going to look back on it, first of all, with different lenses. And secondly, the world now, even now compared to 2-3 years ago, is a very different kind of tech climate than what you extrapolate that out for 10 years and then kind of even more so. So yeah, there's no kind of easy framework. I look back on some of the deals I invested in that went on to do really well, and I went well for a reason. I didn't think they was going to go well, and I look at the ones that that have done less well, and it's the same thing, right? You can't. There's different data points you can extrapolate from each of them, but when you pull that into one data set, there is anomalies everywhere. Backing a good team is obviously the classic one. assessing what really makes a good team is way more challenging. And I think that that kind of VC due diligence process, whatever you do between meeting them to getting that first check, is it indexes highly for extroverts, right? Like it's pitches, it's meetings, it's presentation, it's everything else. And actually, the success or failure probably comes on the layer underneath that. So I'd say the more time you can spend with management teams, that certainly helps. Obviously they've got to have a value proposition. You've got to have if someone can really articulate in one or two sentences why their customers are going to buy their products, that's a good place to start. But if I look at my experience after VC and think about how I compare the two, the one thing that I've learned since is what's in the pitch deck is almost irrelevant. Like it's how quick can you make decisions? How well do the team work together? How quickly can you move and pivot and iterate? None of that makes it into the pitch deck. The pitch deck is just, is this a good idea?
Yeah.
And most people, I think, have a genuine good idea, but how you execute and how you build a management team and the structure around the founders and the hires that you make and everything else, that is nowhere to be seen in any of the pitch deck or process.
I mean, but speaking about the pitch deck, and there's this, then again, as a founder, in my early days of founder, I did not understand this whole thing about venture scale. I thought I did, and I was but I was confidently wrong. Can you touch on, and yes, I was very, very confidently wrong, but can you touch on that quickly for the benefit of, say, first-time founders? What are you looking for in a pitch deck, or when you made a founder, to assess whether they actually are pursuing something that is truly venture scale?
Yeah, I mean, we've talked about the success rates already, haven't we? And them being really small. So the ones that win have got to win big, different depending who you speak to. And obviously different in terms of geography, stage, portfolio construction, everything else. But broadly, you're going to get an answer of probably 10, 20, 50 or 100 times as the returns that a given fund is looking for on their winners. So they've got to, so usually every business that they end up investing into, they've got to have the potential to hit that return hurdle. So, if you're going out and raising a seed round at 5 million quid or pre-seed round at £5 million, and you're trying to, the fund's saying, well, our returns threshold is we've got to get 50x on our winners because we know the success rate is going to be maybe 1 in 15 and we're trying to 3x the fund, then that they've got to say, well, after dilution, am I going to get 50%, 50 times on this? So call it 5 million. Broadly say dilution accounts for half, so that's 10-ish, and then add 50 on that. They're trying to back a £500 million exit opportunity, which are a very small subsection of businesses. One is kind of market opportunity, but I think that's probably overplayed a little bit, because if you can build, even in a niche, if you can build a real compelling business and you get mass distribution and a good product, you will be able to move into other verticals and everything. There's a million stories of how you can diversify your TAM later, but a VC will assess that on the way in. And then the second bit is, this is the hardest part, do you genuinely think that founder wants to go on that journey? And they are going to get a lot. If you're trying to build a business that's going to be worth £500 million, they're going to get a lot of exit offers, right? And if you've got two founders that, let's say, own a third of the business, if someone says, here's 10 million to buy the business, the logical decision for most people is go, I'll take that. Like, especially again, kind of related to if you're in the north of the UK, someone puts 3-4 million quid in front of you. If you, depending on the lifestyle you live, you could probably retire on that, in your 20s. So that's a kind of difficult one of going, does this founder really have the appetite to go the whole way? And yeah, that's always been the toughest question to answer.
Interesting when we come back to see the work you do now in supporting founders, because I see that as very critical. But yeah, moving on to the other interesting part, the kind of irony to it, which is, as a VC, you were making these decisions, you were deploying these checks, but you've also been very vocal about saying many, many founders should not be raising. Tell me more about this. How should founders, especially new ones who are ambitious, how should they, take that decision whether they should go into VC, take on VC or not?
Yeah, so from my perspective, it's about finding the right solution, the right capital solution for a given business. And I think part of the challenge is there's a lot of people in and around the VC industry that are motivated, financially and otherwise, to perpetuate this view that VC should be for everybody, and it absolutely shouldn't. Some accelerators are a classic for this. Like, some accelerators are great. It's how many companies can we support, and that in 5 years' time they're still a business and they hire people. That's great. When it becomes how many people can we get funded, you're driving a very different behavior then, because if there's 20 people on an accelerator, the likelihood is not all 20, even if you're screening for those that are VC suitable, not all 20 of them should be raising. And if your only metric is the amount of funds that have been raised through that program, I don't think you're giving founders the best advice to kind of go on and grow their business. So I've always just tried to provide that view back into the market, that VC is great for some people, and for other people, there are definitely better routes depending on what you want to do. And I don't think that should cross. I think all VCs should say that, and I don't think it should cut across anything that's being done, because VC is not a game of investing into everybody. It's a game of investing into a very small select few. And actually, it's better for the VCs if the businesses that aren't VC ready go out and bootstrap, instead of ultimately getting 1,000 pitch decks of which you're only going to do like 5 of, because people that should be bootstrapping have come to VC. And longer term, I would say, VC really should be used for 2 things. It should be used to unblock a problem that you've got. So think about pre-seed, and it's probably different now in the AI world we live in, but it's been very difficult historically for teams to build that first good product. And you probably needed $500,000 to $1 million back in the day to build an enterprise SaaS solution that you could even kind of really get an early adopters onto. So you needed to unblock that. And then the later stage market obviously comes in, where you are growing so quickly that you don't want to wait for revenues. You don't want to wait for profit to come back in to reinvest it. You just want to go quicker and quicker and quicker. VCs can make money very well on both of those 2 solutions. And the more people that bootstrap, the more likelihood that you're going to get more of those second type of businesses, where they're going, we've bootstrapped, we've learned, we've put a really small marketing budget, we've hired 2 salespeople, one's worked out, we've refined all that. But now actually over the last 6 months, here's our unit economics, here's how it's scaling. Can you pour more money in the top? I think it will just create a lot more healthier businesses that can ultimately then, if they choose, go on to raise VC money.
Yeah, I thought as well, but I just thought I'll try. But on the flip side, again, without mentioning names, are there any deals maybe that crossed your table and you're like, nah, I don't want to do this, but then ended up being like high flyers?
I don't know about that. There's been some that have come really, 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 really close to, and just for various reasons it didn't work. Obviously, when you work for a fund, there's a criteria around what you can invest into, and I always liked a lot of the very, very early stage stuff. But the fund I worked with was more kind of seed than pre-seed. So there was a few pre-seed businesses that I saw, and I was like, oh, I'd love to be able to do this, but it just didn't fit in terms of check size and stage and stuff like that. But yeah, I keep in touch with a couple of them. One of them, so when I first saw one of them raising on an 800K post money, so it was like very much inception stage, and it was just, the founder was just phenomenal, but they had nothing. So there was an angel thesis, but there was no VC thesis. So it wasn't one that I kind of, even took forward as a potential investment, but I knew the founder was going to do something. Then I met him about 18 months later, and it was raising at 8 million. And again, that just didn't work with kind of the fund that I was working with on at the time. And then he texted me the other day and said, just to let you know, we've closed a £10 million safe, and we've got, we're just kicking off a 40 mil. This is raise amount, not valuation. We're kicking off a £40 million raise with some US investors. So even if you assume 20% dilution, that's probably a £200 million round. So I know one of the angels that went into that first round at 800K, and I think he will be a very, very happy man at the moment, especially if he can get some out as a secondary.
Very interesting, but that's how VC works, right? So
Yeah.
you win some, you lose some. At this point, tell us, Catenae, how did that come about after your foray in VC, and what do you do?
Yeah, so I wanted to leave VC probably from the start of 2024. I say wanted to leave it. I was enjoying the day to day, but I knew there was something else that I wanted to do. But then I had a baby in February, got married in August. I was in the middle of a house renovation. So I was like, actually, be quite nice to just get paid at the end of the month, not worry about going out and finding clients. So I ended up kind of staying around for a little bit longer than I thought, which would always be my advice to anyone that's trying to set up on their own, whether you're trying to build a product business or a services business. if you think you're going to leave your employer, just spend 6 months doing your job well, doing the job that you're paid for, but spending your evenings and weekends working out what comes next. Do not follow the advice of, if you hate your job, just quit. And I didn't hate my job. I love my job day to day, but I just wanted to do something slightly different. So anyway, got married in the August. I got married abroad. It was literally like 3 or 4 days after got married. Literally bolted upright on my sun lounge. I was like, I'm going to resign. I'm going to get home. And my wife had tried to put me off it for a little while beforehand, just because of all the stuff that was going on. She's like, yeah, that's fine. Yeah, we've paid for all the big stuff, all the kind of big life events. Just go for it. So come back, resigned. I think I finished in October 2024, something like that. But in the meantime, obviously, I had a really great network from VC. So I've managed to kind of find quite a few initial clients. So it's a very soft landing. Everyone says like, oh, it's really brave to go off and set up your own advisory business. I'm like, it is. But if you can spend a bit of time working out what you're going to do, then it's definitely not as risky as what it is if you just go cold. So yeah, I did that. I work with, and there's kind of two different types of clients that I work with. So one is B2B software businesses, and the other is more kind of like innovation hubs. And I'll kind of touch on both, but I guess starting on the latter actually. That's kind of, so there's one of my clients there is called Funded, which is Lancashire County Council funded initiative to support businesses that are trying to fundraise in the region, either with introductions to VCs, because a warm introduction is always going to increase your chances of raising more than going into a cold inbox. And also we're building up quite a big angel network. I say big for the region, kind of angel network that also looks at deals. So I do a lot in terms of getting the founders ready for investment and curating the deal flow for that angel syndicate. And then I do a little bit with Baltic Ventures, again, just helping, but again, that's kind of cohort type program, just helping businesses get ready for investment. So that's cool. And it just keeps me that little bit still with that variety and meeting a lot of businesses and still keeping a bit of the VC hat thinking. What an angel deal looks like is significantly different than a VC deal, but just in terms of meeting a good breadth of businesses and keeping that kind of intellectual curiosity, that's good fun. But I don't have to do any of the legals or paperwork or investment committee papers. So that's great. And then that takes up about a third of my time. And then the other 2/3 of my time I spend working with enterprise SaaS businesses, helping them to try and go from typically kind of seed to Series A. And the role and the kind of tasks and projects that get involved in with those businesses are very different across each of those businesses. So again, I go all the way back to my first job. It's the same process now. Jack of all trades, master of none. And I've sat in lots of boardrooms, I've sat in lots of management meetings, I've seen a lot of what goes well and what goes less well. So most things I can kind of turn my hand to. And yes, I'm probably not the absolute expert, but I can probably get you 80-90% of the way there on 5 or 6 different tasks. So a lot around building dashboards, getting the right kind of data and analytics running through the business, helping the founders or the CEO kind of take one step up in terms of assessing things from, a bit less in the weeds day to day. So instead of going, I've got to go to the sales meeting and the marketing meeting and the customer success meeting and the product meeting, actually, how do we get proper data running through the business and, like I say, proper kind of dashboards, OKRs, KPIs, so that he can take a bit more of a step out of the day to day. And then where there is a problem, he's got sufficient time to dive in and do that properly. But yeah, just kind of operationalizing the business a little bit more, not getting to the point where you've got IBM level processes, but just a bit more. How do we set KPIs to make sure the day-to-day stuff is being done well? And then on top of that, how do we set some OKRs so that we can make big jumps forward in 3 to 6 months? But you can only really do that if you've got the structure around it. So do a lot of that. Other bits I've kind of took on, I've ended up doing a project where one of the software businesses I work with, they mainly make money through licensing, but they've got so many eyeballs on the platform now. There's other revenue opportunities that they can unlock, like insurance referrals and partnerships and stuff like that. So I've helped them map that out. One of my clients is looking at international. So again, kind of helping with that and how do we work out which markets are most similar and where do we go to next and how do we take the learnings of what that business has had for the last 2 years in the home market and then apply that we think within 6 months of entering a new market, we'll be at the point where we've been on this 2-year journey, because we're kind of, just trying to document and understand a bit more of the various parts and just doubling down on what goes well. Often a lot around pricing and kind of repricing. speaking to customers, getting kind of feedback on the product. So lots of different stuff. But really, if I had to kind of sum it down, you call it probably founders associate, chief of staff in today's world, but with a bit more of a data process analytical view to bring some balance to the founding team that are usually a bit more, as all founders are, kind of fly by the seat of your pants, and it'll all be okay.
Amazing. What you kind of described there describes the entire chaos around startups. I mean, it gives me just a bit of fright hearing you describe. But one thing that struck me there was you've kind of gone extreme from being on the VC side, which is very high level. I would have expected you to maybe on the founder side help them with the fundraising cap table issues, but it seems no, you get it into the weeds. Is that by design?
Yeah, absolutely by design. Yeah, I think so. Some people say, "Can you help me with fundraising?" And I say, "Well, what do you want with fundraising? Because if you're trying to raise a round in the next 3 months, I can't help you. Either you've already done it yourself, and there's no point paying me because you've built a really good business that you can fundraise on the back of it, or there's some fundamental changes you need to make in your business. The pitch deck is not going to help you raise. Like that is 5% of the story. Yeah, if you're saying, actually, I've been building a lifestyle business or a bootstrap business for 3 or 4 years. I've had to live hand to mouth. I've got a few sticky tapes on the product. I've got some MI, but my MI doesn't really make sense because I've been cash accounting and doing it all myself. And actually, I want to get ready. I've now got, pick a number, I've got £1 million of revenue. Because I work with VC-backed businesses. So like one of my clients has raised nearly £5 million. And I also worked with a business that you'd probably say it was seed strapped, but that was long before seed strapping become a thing, where they raised like £500,000 at the start, and then they've grown organically and doing a couple of £1 million of revenue now, but just growing based on profits. So I kind of see both ends of the spectrum, but I absolutely can help you with fundraising if it's a 6 to 12 months goal and you've got clear problems you need to fix in your business. But if you want me to just help you polish a pitch deck and pull together a financial model, you can get someone a lot better than me to do that.
Okay, so what I hear is, from your point of view, preparing for fundraising should be a
Yeah.
long-term thing.
Yeah, absolutely. Yeah, you've got to get a business that can be fundable, and you need the data that sits underneath that. But what I find is it's not often a case of people. Sometimes it is, but it's very rarely a case of people have the data but they don't know where to find it or they don't know how to present it. So like a classic one is like your customer acquisition costs. Like very, very seldom do people go, "Oh, I've got all the data, I just need to assess it." They don't know. The sales team haven't tracked how long a deal takes. They haven't got the right analytics running through their website. They've not got the campaign set up in a way where they can track. So that's going to take you probably a month to 3 months to get that infrastructure in place. But then, like, you can't short circuit time, right? It's going to take you 6 months to have 6 months of data to then present that to investors. If you're raising a pre-seed round, very different. But majority of the clients I work with are on that seed to Series A journey. So, a bigger fundraise is the kind of part where they're trying to get to, and that will be about having the data pack to support what you're saying in your deck.
Very interesting. I mean, I've been looking at some of the data recently. Qatar does like very good, this data visualizations. I think the C to Series A graduation rate seems to be around 30% now. That's in the US, which
Yeah.
I don't see it's going to be any better here. I mean, what are your thoughts on that? How do you help? I mean, the companies you work with from the operational side, how do you help them improve their odds of crossing that gap?
It's ultimately, what's your value proposition? If you can really articulate what your value proposition is, you're going to be, first of all, it's going to help your investor conversations. Secondly, you're going to be winning. You're going to be winning so much business that your traction is going to speak for itself. Then you're probably into you go to market, and that's vastly different for lots of different businesses. So like one of my clients, their lowest customer probably spends 500 a year and the biggest customer spends 100 grand a year. So actually the sales team could target everyone, right? But that wouldn't be a kind of successful strategy. So a lot of the work that I've been doing there has been working out when you compare sales cycles and you compare ACV, which part of that really will move the dial in the next 6 months. And actually it's 5 to 10k ARR, 5 to 10k MRR deals that are the ones that are really worth spending time on. can you build something around that? And then again, back to the same boring point of when you get interrogated on, have you assumed this? Have you assumed this? Do you understand? If you've got a value proposition, you know how to sell it and you know your unit economics, the conversations become really, really easy at that point.
Very interesting. Yeah, I mean, like you said, it all boils down to those three, but getting those three right is the difficult part. And I guess that's where a lot of founders need you. One thing there again is, we've talked a little bit about the UK versus Europe versus rest of the world. How do you see venture in Europe over the next few years in the UK versus the US? Do you think the UK is going to catch up, or do you think this gap is still going to remain for a while?
So I don't mean this in a negative way, but the UK will never catch up with the US because that isn't because it's like in a pitch deck when someone says it's funny, you get the like crosses and ticks on the competitor slide, and
I've
obviously
been guilty of that.
inevitably there's ticks all in the founders boxes, and then they go, "Can you show me this bit?" And they'll say, "No, that's on our roadmap." So they kind of take their finished product and compare it with the market's current product, and it's like, well, how do you know that those other well-funded later stage competitors are not going to be working on things as well? Obviously, they are going to be. And it's the same with the UK and the US. So we can continue to make really big strides forward. And I think AI is helping with that, and the whole remote working and the kind of distribution of talent and everything else, especially like say out of Europe, you look at like, I think Lovable, is that Sweden or Finland? It's
Yeah,
certainly one of the Scandinavian countries. There's quite a few other quite high profile ones as well, in that sort of generative AI space. Segura is another one, isn't there? So there's quite a few in Europe that are making some pretty big waves. So we'll continue to step forward, and that's great. But I think we just need to stop comparing ourselves with the US, because it's almost a case of, can you compare UK venture to what it was 5 years ago, 10 years ago, and how we improve it? And US, I mean, you look at the US GDP compared to the kind of global GDP, you do the same thing for um, market cap on their stock market compared to everyone else's. Like they've kind of won. Like it's not going to change in the next probably 100 years, in my view. But that shouldn't mean we're not doing great things.
absolutely. I mean, I'm bullish on the UK as well as well. To your point, it's never going to be the US. The US is the US. But I think that gap will most likely close. I mean, I foresee a situation where more startups will choose to stay here and build out of here. One more point, that you've been quite vocal about is exits. It's been quite abysmal in the UK market. What do you think is the problem there?
Well, the UK stock market is definitely not what it is compared to the US. You look at some of the businesses that have listed over the past 3 or 4 years, they've usually chosen where they can to list in the US anyway. And there's a million reasons for that. But a lot of it goes back to cultural piece. If you look at some of the top areas of it, CEO compensation is one. There's a much bigger and healthier appetite for that to be a meaningful amount for the stress and strain of running a public business in the US than what the kind of appetite is for the UK. So there's a big part of that there. I think secondly, which is quite a different, so that's about where businesses do ultimately choose to list and then what that means in terms of the data. In terms of size of exits, I think part of the challenge in the UK is we've not got a big enough secondary market. So I go back to that founder that's been offered £10 million to sell the business and they own a third of the business. The rational man or woman says, I'll take my chips off the table now. But if you create, which the US has got a lot more of, if you create more of a healthier appetite of going, well, no, you can sell 20% of your shares and that pays off your house and your car and your kids' school fees or whatever it may be, and then you roll the other 80% in and continue, you've got a lot bigger likelihood that the founders are going to continue to turn down more and more offers because they've got that million in the bank. So actually the second and the third one's not as important. They're then shooting for the tens and the 20s and kind of hundreds or whatever it may kind of lead to. So I do think we need to address the problem of secondaries market, and everyone points to the few stories where it's not been successful, and everyone goes, oh, well, look at what happened with WeWork, right? The founder made loads of money and the investors didn't. And you're like, but that's one, and you can maybe find, another handful. But I think there needs to be a more healthy appetite to just letting founders de-risk as they go through the journey. Yeah, I think that would help as well.
Very, very interesting. I mean, what I'm doing with 23 Mile is partly, somewhat that, helping founders who want options,
Yeah.
rather than shut down after Series A, turn it profitable, find a buyer, So we'll see. I mean, I have vested interest in hoping as well that that secondaries market continues to do well. Time has gone by very quickly, but in wrapping up, I just have a few quick fire questions for you.
Cool.
If you were going to, yeah, so if you can give me a word or a sentence, yeah, that'd be great. If you were going to start a tech startup, or, a if you're going to found something in the future,
Yeah.
would you raise VC or bootstrap?
Bootstrap, certainly on day one. Bootstrap and until otherwise.
Keeps your options open. Great,
Yeah.
amazing. What's the biggest myth about entrepreneurship in your years in the space?
That if you put the hard work in, you will be successful. The hard work
Ooh,
is only a ticket to play. If you don't put the hard work in, you won't be successful. But if you do put the hard work in, you still might not be.
that is a deep one, and I want to dive into that a bit. I mean, again, a bit of personal experience, but I bought into that narrative that, fundraising is a numbers game. If you pitch 100 VCs, for instance, one will say yes. That's a big lie. So that's something like what you're saying, right? You can put in all the hard work, you still may not succeed.
Yeah, yeah, agreed. And it's the decision making you make in a startup, it's probabilistic. It's not scientific. Nobody knows what the answer's gonna be. So yeah, it drives me mad. I call it out on LinkedIn all the time, where that classic story of like, oh, I've slept in the back of my car, and you're like, great, and you've been successful, and you've got hundreds, reposts because you're the big person that's been successful. But actually, there's another 99 people over here that also slept in the back of the car, and they're still sleeping in the back of the car because it is an unforgiving and brutal game.
Okay, last one. What's the fastest decision you've ever taken to back a founder?
Don't know, but on the basis that I've never wrote an angel check yet, and it's primarily been my investing experience has primarily been with it working as a VC. In a VC, it's never your choice. You're kind of working on stuff as a team, and you've got investment committees and processes and everything else. So I think the quickest deal I did was about 7 weeks. Which yeah, but the decision, if it was my decision, it's solely my decision. If I was making an angel check, I'd probably make it after like a second or third meeting. Because what you don't know after there, you're not going to know. Or if you do, yeah, you either don't need to know it, or no matter how many meetings you have, you'll never find it out.
Absolutely. I have one last one. I know I said last one before, but I have one last one. How important is founder pedigree to fundraising?
What do you mean by founder pedigree?
Schools they've gone to, whether they've worked at big tech, etc.
It obviously helps if you look at the way a lot of the tier one VCs screen. That is clearly part of their decision making. But one of my clients has got a tier one software investor from Europe on their cap table, and they would have fitted none of that traditional investment banking Ivy League FANG group. So if you've got real deep industry experience and you can get in front of the right investor within the funds that you're speaking to that resonate with the problem you're solving. So appreciate that's a fair few circles on a Venn diagram to overlap. But if you can align all of them, then yeah, not having an Ivy League or Russell Group university on your CV or a FANG company is not going to stop you.
Amazing. Thank you very much. And on that note, thanks for joining me. And yes, keep up the good work. Keep educating founders and stopping your people from making stupid mistakes.
Yeah, no, appreciate that. Really enjoyed the chat, and thanks for having me on.